Imagine waking up tomorrow, checking your bank account, and realizing that most of your paycheck was already spoken for before it even arrived. Not because someone stole your money, not because you lost your job, but because every dollar has already been assigned to rent, groceries, subscriptions, insurance, car payments, and one small piece of plastic sitting quietly in your wallet, your credit card. It promises convenience, rewards, cashback, travel points, and financial freedom. But what if that promise hides a very different reality? What if the card wasn't designed primarily to make you wealthier, but to keep one of the most profitable industries in history running? Every day, millions of people tap, swipe, or insert their credit cards without giving it a second thought. The payment is approved within seconds, the receipt is printed, and life moves on. Yet behind that simple transaction, an enormous financial machine instantly comes to life. Banks begin tracking balances, payment networks process the transaction, merchants pay fees, credit bureaus update financial profiles, interest calculations start ticking. Powerful algorithms analyze spending habits, predicting future purchases and borrowing behavior. To the customer, it feels like a simple purchase. To the financial industry, it's another piece of a system worth trillions of dollars every year. Most people believe debt begins with reckless spending, luxury vacations, expensive cars, designer clothes, or impulsive shopping. Reality is often much different. Debt usually starts with something ordinary: a broken car that needs immediate repairs, an unexpected medical bill, rising grocery prices, a family emergency, a household appliance that suddenly stops working. In moments like these, the credit card doesn't feel dangerous. It feels like a lifeline, a temporary solution to a temporary problem. But temporary solutions have a way of becoming permanent habits. One purchase becomes several. Then comes a month when paying the full balance simply isn't possible. Instead of clearing the debt, the monthly statement offers another option, the minimum payment. It seems harmless, affordable even. After all, the bank itself says that's all you need to pay right now. What many people don't realize is that this small decision can quietly change the entire future of their finances. The debt doesn't disappear. It simply survives another month, continuing to generate interest while making the next payment even harder. This is where the credit card business becomes fascinating. If you borrowed money from a friend, they would probably want every dollar back as quickly as possible. Banks operate differently. Of course, they expect repayment, but under the right circumstances, slow repayment can actually become more profitable than fast repayment. Every extra month that a balance remains unpaid creates another opportunity for interest charges. Additional purchases increase the balance. Late fees may appear. Over time, a customer who originally borrowed a few $100s may end up paying far more than the original purchase was ever worth. Over the last few decades, something else has quietly changed. The meaning of money itself has evolved. Years ago, buying something usually meant you had already earned the money needed to pay for it. Today, millions of purchases are made using income that hasn't even been earned yet. Tomorrow's paycheck pays for yesterday's shopping. Next month's salary covers last month's spending. The future becomes committed long before it arrives. Without realizing it, millions of people begin living one paycheck ahead, always trying to catch up with promises they made weeks or even months earlier. Credit cards didn't invent human desire. People have always wanted better homes, newer cars, fashionable clothes, and the latest technology. What credit cards changed was the waiting. Instead of saving for months before making a purchase, people could own something immediately and worry about payment later. The emotional excitement of buying became completely separated from the financial pain of paying. By the time the monthly statement arrives, the excitement has already faded, making it easier to repeat the cycle again and again. Behavioral economists have spent decades studying this pattern. Human beings naturally place greater value on immediate rewards than future consequences. It's one of the strongest psychological biases ever discovered. Credit cards fit perfectly into that behavior. They remove the immediate feeling of spending money, replacing physical cash with a quick tap or swipe. As a result, buying feels almost effortless. while the true cost remains hidden until weeks later. Here's the surprising part. Banks don't need every customer to fall deeply into debt to make billions of dollars. Some people pay their balance in full every single month. Others occasionally carry a balance, some miss payments, others pay interest for years. Every type of customer contributes differently to the same financial ecosystem. Banks earn money from merchant fees, interest payments, annual fees, partnerships, and many other sources. The business doesn't depend on one person's financial mistakes. It depends on millions of everyday transactions happening every hour across the country. Today, credit cards have become so normal that most people rarely stop to question how the system actually works. They're accepted almost everywhere, from grocery stores and gas stations to hospitals and online shopping websites. They feel like an essential part of modern life. Yet behind that convenience lies one of the most sophisticated profit machines ever created, one that has transformed borrowing, spending, and personal finance in ways few people truly understand. So how did the world reach this point? How did a simple payment tool evolve into a multi-trillion-dollar industry? Why were banks willing to lend billions of dollars to complete strangers? And why has carrying debt become so normal that many people no longer question it at all? To answer those questions, we need to go back to the beginning, long before reward points, cashback offers, and digital wallets existed, when one simple idea changed the future of money forever. Long before credit cards became a part of everyday life, buying something was remarkably simple. If you had the money, you made the purchase. If you didn't, you waited. In small towns across America, local shopkeepers sometimes allowed trusted customers to buy now and pay later, but this was based entirely on personal relationships. The store owner knew your name, your family, and your reputation. Credit wasn't a product, it was trust. By the late 1940s, America was changing rapidly. The economy was booming after World War II. Millions of families were moving into new suburbs, buying homes, cars, televisions, refrigerators, and other modern conveniences. Consumer spending was becoming the driving force of the American economy. Businesses wanted people to spend more, but there was one problem. Most purchases still depended on cash or checks, limiting how much consumers could buy at any given moment. Everything changed in 1950. According to the widely known story, businessman Frank McNamara finished dinner at a New York restaurant and realized he had forgotten his wallet. Whether every detail of that story happened exactly as remembered is debated, but it inspired a revolutionary idea. What if people could carry a single card that allowed them to pay later? That idea became the Diners Club card, the first widely recognized charge card in America. The Diners Club card wasn't a credit card as we know it today. Cardholders were expected to pay the entire balance at the end of each month. The timing is no accident. Human beings naturally value immediate rewards more than future consequences. Psychologists call this present bias. In simple terms, our brains tend to prioritize what feels good today, even if it creates problems tomorrow. Credit cards fit perfectly into this pattern. They allow people to enjoy the reward immediately while postponing the cost until later. The future version of ourselves becomes responsible for paying decisions made today. This is one reason online shopping has grown so dramatically. A product catches your attention, reviews look promising, a limited time discount appears on the screen. The checkout process takes only a few clicks. There's almost no time to pause and reconsider. The easier the purchase becomes, the less time people spend questioning whether they truly need it. Then come the rewards: cashback, airline miles, hotel points, exclusive offers, premium memberships. On the surface, these programs appear to reward smart spending. And for disciplined users who always pay their balances in full, they can provide genuine value. But rewards also serve another purpose. They encourage people to use their credit cards for nearly every purchase, no matter how small. Instead of asking, "Do I really need this?" many people begin asking, "Why not earn points while buying it?" Marketing adds another powerful layer. Credit card advertisements rarely focus on debt or interest rates. Instead, they sell experiences, Luxury vacations, fine dining, freedom, convenience, success. The card becomes more than a payment tool, it becomes part of a lifestyle. Over time, people stop thinking of borrowing as borrowing, it simply feels like spending. Perhaps the most effective psychological strategy is the minimum payment. When customers receive their monthly statement, they usually see two numbers. For many people, credit card debt doesn't begin with a financial disaster, it begins with optimism. The balance feels temporary. A few $100s today will be paid off after the next paycheck. Then another unexpected expense appears, a car repair, a medical bill, higher grocery prices, a home emergency. Before the original balance disappears, a new one takes its place. Without realizing it, borrowing slowly shifts from being an occasional solution to becoming part of everyday life. At first, everything seems manageable. The monthly payment is affordable, the credit limit still has room, and life continues as normal. But debt has a unique characteristic. It grows quietly. Unlike rent or utility bills, which arrive and are paid, revolving credit has no fixed ending date. As long as a balance remains, interest continues to accumulate. Each month becomes a little more expensive than the last, even if spending has slowed down. This creates a dangerous cycle. A person works hard, earns a paycheck, makes the minimum payment, and feels a sense of relief. But most of that payment may simply cover interest and fees rather than significantly reducing the balance. The debt survives another month, ready to generate even more interest. Financial progress feels frustratingly slow, and many people begin wondering why their balance never seems to disappear. Then comes another challenge: inflation and the rising cost of living. Over the past several years, many households have seen groceries, housing, insurance, healthcare, and transportation become more expensive. Salaries don't always increase at the same pace. When everyday expenses consume a larger share of income, credit cards often become the easiest way to fill the gap. What begins as short-term borrowing gradually turns into long-term dependence. Life also has a way of delivering surprises. Few people plan for a medical emergency, sudden unemployment, or an expensive home repair. During these moments, access to credit can provide valuable flexibility. In fact, when used responsibly and repaid quickly, credit cards can be useful financial tools. The problem begins when emergencies become recurring, income remains under pressure, or balances continue growing faster than repayments. There's also an emotional side to debt that numbers alone can't explain. Carrying a large balance often creates stress, anxiety, and guilt. Some people avoid opening their monthly statements because they fear seeing the total amount owed. Others continue spending simply to maintain a lifestyle they feel unable to support with current income. Debt doesn't only affect bank accounts, it can influence relationships, mental well-being, and long-term financial confidence. As balances grow, many borrowers receive offers for additional credit, higher limits, balance transfers, new reward cards. From one perspective, these offers provide flexibility. From another, they can encourage people to move debt rather than eliminate it. Instead of solving the underlying financial problem, the debt is simply shifted from one account to another, allowing the cycle to continue. The most surprising reality is that many people trapped in credit card debt are not irresponsible. They work full-time jobs, they pay their bills, they budget carefully. They simply find themselves living in an economy where one unexpected expense can disrupt months of financial planning. The system isn't fueled only by reckless spending, it also reflects the financial pressures faced by ordinary households. This is what makes the credit card industry so remarkable. It doesn't rely on a few people making catastrophic mistakes. It relies on millions of small decisions repeated every day. A minimum payment here, an emergency purchase there, a balance carried for one more month. Individually, these choices seem insignificant. Collectively, they help power one of the most profitable financial industries in the world. But if interest and debt are only part of the story, where do the industry's biggest profits actually come from? The answer lies in a complex network of fees, pricing strategies, and financial mechanisms that most cardholders never notice. And that's where the business becomes even more fascinating. Most people believe that if they avoid missing payments, they're safe. They assume the only real cost of a credit card is the interest charged on unpaid balances. But the modern credit card industry is far more complex than that. Behind every account is a carefully designed pricing system where small charges collected from millions of customers quietly add up to billions of dollars each year. Let's begin with something almost every cardholder has seen but few fully understand: the annual percentage rate, or APR. When you first receive a credit card, the advertised interest rate may seem like just another number buried in the terms and conditions. Many people barely look at it because they expect to pay their balance in full, and for some, that works perfectly. But when a balance remains unpaid, the APR determines how expensive that debt can become over time. What starts as a relatively small purchase can become significantly more costly simply because interest continues accumulating month after month. Late payment fees create another important source of revenue. Missing a payment by even a short period can result in an additional charge, while repeated missed payments may also affect a person's credit history. For customers already facing financial pressure, these extra costs can make catching up even more difficult. A single missed payment doesn't just increase the balance, it can trigger a chain reaction that becomes harder to stop. Cash advances represent another feature many people underestimate. On the surface, withdrawing cash using a credit card may seem convenient during an emergency. However, cash advances often come with separate fees and may begin accruing interest immediately, without the grace period that usually applies to ordinary purchases. As a result, borrowing cash through a credit card can become one of the most expensive ways to access money. Then there are foreign transaction fees, balance transfer fees, return payment fees, and annual membership charges on certain premium cards. The difference isn't the card, it's knowledge. Because banks understand one simple truth: an informed customer makes different decisions than an uninformed one. That's why understanding money is often more valuable than simply earning more of it. The financial world has changed dramatically over the past few decades. Cash is disappearing. Digital payments are becoming the norm. Buy now, pay later services are expanding. Artificial intelligence is reshaping lending decisions. And every year, borrowing becomes faster, easier, and more invisible than ever before. The question isn't whether credit cards will disappear. They won't. The real question is whether people will continue using them without understanding how the system actually works. Every swipe is more than a purchase. It's a financial decision. Sometimes it's a smart one, sometimes it isn't. The challenge is knowing the difference. Because in today's economy, financial freedom isn't measured by how much credit you have. It's measured by how little you need to depend on it. The next time you reach into your wallet and pull out your credit card, take just 1 second before you tap. Ask yourself one simple question: am I buying this with today's money or tomorrow's income? That single question may seem small, but over the course of a lifetime, it could become one of the most valuable financial habits you ever develop. If you enjoyed this documentary and want to explore the hidden systems that shape money, banking, and the global economy, make sure to subscribe and join us for the next episode. Because sometimes the biggest financial secrets aren't hidden in vaults, they're hidden in plain sight. Thanks for watching.